Besides his work co-headlining the Berkshire Affair and various other business and philanthropic ventures, people know Charlie Munger for his eloquent, multidisciplinary mind. Trained as a meteorologist during World War II and as a lawyer at Harvard before devoting himself to business, Munger has drawn massively from studying psychology, economics, physics, biology, and history, among other disciplines. As a result, his business and life insights are unique, rare, and correct with unusual consistency. Munger has a strong track record of outperforming the stock market. He has also been an integral part of Berkshire Hathaway's successful performance as Warren Buffett's right-hand man. The company's compounded annual gains of 20% have been almost twice those of the S&P 500 between 1965 and 2019. At 97 years old, Munger has had a long investment career. Although he has been successful for much of that time, some of his investments have been significant failures. Still, his investment career has contributed to him obtaining a net worth of around $1.6 billion. Recently, Charlie Munger expressed his concerns about where the markets are today. He made a sobering prediction about the future, one that investors shouldn't ignore. With that said, let's take a look at 10 reasons why Charlie Munger is predicting a stock market crash. Warren Buffett has used his past observations to guide his investing decisions, contributing to his success over the years. However, not even he is sure about the long-term effects of the crisis on the economy. One of Warren Buffett's most famous quotes is, "Be fearful when others are greedy, and be greedy when others are fearful." According to this, investors need to buy quality stocks at every market correction. In the long term, equity markets continue to move higher and can create extensive wealth. You would think that the Oracle of Omaha would have bought several stocks in the recent market crash. However, Munger shocked investors by saying that Buffett did not buy stocks in the 2020 bear market. In fact, Berkshire Hathaway's cash balance rose to $137 billion at the end of Q1, from $128 billion at the end of 2019. This could mean that Warren Buffett expects another market crash in the second half of 2020. Like everyone else, Munger doesn't know what will happen since the global health situation is a crisis like we have never seen. So he prefers not to take action. He doesn't know how long the recession will last and how much damage it will cause to the economy. Although Munger doesn't believe we'll have a Great Depression, he thinks it's quite possible that we will never again have a level of employment like we just lost. He stated that he didn't have the faintest idea of whether the stock market will go lower than the old lows. Munger might actually have no idea if there will be another stock market plunge. Still, his lack of action implies he might think the market will go down again, but he simply doesn't want to cause more concern by saying so. For Munger, the market is probably still not cheap enough to start buying stocks, but he might begin to invest if there is a deeper stock market sell-off. Berkshire's philosophy is to buy when the bargains abound. Nobody claims there will be another stock market crash. However, with the dark economic outlook, it may be wise to mimic Munger and stay on the sidelines until things stabilize. Charlie Munger considers the latest market rally to be one of the most surprising things that has ever happened in the history of finance. He believes that there are bubbles, but nobody knows when the bubbles are going to blow up. Where the markets are right now is comparable to the dot-com bubble. And Munger states that he thinks it must end badly, but he doesn't know when. Munger's fears aren't unfounded, as the S&P 500 is at a price-to-earnings ratio of nearly 40, and it only went higher than that during the financial crisis in the dot-com bubble. Right now, valuations are extreme for many investments, and the risk is that a correction or large-scale crash may be necessary. However, that doesn't mean that it'll happen tomorrow, next week, or even a month or two from now. When speaking at an annual meeting for Daily Journal Corporation, Munger had some harsh words for aggressive investors, comparing some of them to racetrack bettors who were buying stocks on a frenzy.
For a 23-year-old with high ambitions, some initial working capital, and a genetic wiring, as you call it, for disciplines like investments, mathematics, and technology, what do you foresee as the significant areas of opportunity over the next 50, even 100 years? And if you were in my shoes, what would be your approach and methodology for really learning, tackling, and mastering these areas of opportunity for the purpose of massive value creation?
Yeah, and of course the place to look when you're young is in the inefficient markets. You shouldn't be trying to guess whether, one drug company has a better drug pipeline than another. You want to go, when you're young, someplace that's very inefficient.
And you shouldn't be trying to guess whether the stock market's going to go up or whether long-term bonds are going to change in yield. I mean, you don't have anything going in that kind of a game. But you can have a lot going in games that very few people are playing, and maybe where they're even got their heads screwed on wrong in terms of how they're thinking about the subject. The RTC was a great example of a chance to make a lot of money. I mean, here was a seller of hundreds of billions of dollars worth of real estate where the people that were selling it had no economic interest in it, were eager to wind up the thing, and they were selling it at a terrible time when the people who had been venturesome in lending were no longer lending. The people who had been venturesome in the equity end of real estate had gotten cleaned out. So you had a great background of environment, and then you had an imbalance of intensity in terms of analyzing situations between the seller, which was the government, with a bunch of people who had no economic interest in it and were probably eager to wind up the job, and buyers on the other side who were of the generally cautious type, because the more venturesome type had taken themselves out of action. And there were huge amounts of property. So you get these opportunities, and you'll get more. I mean, there won't be any scarcity of opportunities in your life, although there will be days when you feel that way.
Many of them are mindlessly buying numerous shares in their favorite ETFs regardless of the surging valuations in the underlying holdings. By ignoring the hype and patiently focusing on the value while guarding against the downside to allow our winners to take care of themselves, we have been able to outperform the market since our portfolio's inception significantly. In order to protect themselves, investors only need to reevaluate their portfolios. Munger highlighted how much risk investors are taking when investing.
I think the Chinese have behaved very, very shrewdly in managing their economy, and they've gotten better results than we have in managing our economy.
Particularly in China. He noted that people love to gamble in stocks in China, which he thinks is a big mistake. I think there are lots of troubles coming, he said at the Los Angeles-based Daily Journal annual shareholders meeting. There's too much wretched excess. In China, they love to gamble in stocks. This is really stupid, Munger said. It's hard to imagine anything dumber than the way Chinese hold stocks. Only in the US, investors risk varying from the current global health situation impact on the economy to political uncertainty from the presidential election. Also, it was announced that the US budget deficit increased by 25% in the first 4 months of the fiscal 2020 period to $1.06 trillion. Munger says it's very common for investors to get overconfident as they start getting a taste of success. According to him, although some people may be utterly brilliant, they make the mistake of thinking they're way more intelligent than they are, and end up doing worse than even the dumbest people. Munger adds that investors should keep things as simple and fundamental as possible and avoid their own mental biases. I spent a lifetime trying to avoid my own mental biases. I rubbed my own nose in my own mistakes, and I try and keep it simple and fundamental as much as I can. I like the engineering concept of a margin of safety. I'm a very blocking and tackling kind of thinker, he says. Moreover, Munger says he tries to avoid being stupid. He said he has his method of managing problems. Munger puts them on the so-called too hard pile, leaves them there, and doesn't try to succeed in that pile because sometimes he faces challenges that are too hard, and when that happens, he fails to overcome them. He is confident that if investors want to avoid stupid errors, they should know their areas of competencies. But identifying these areas is not easy due to the bias of the human mind. Charlie Munger has advised investors to not buy Bitcoin or gold. He thinks the cryptocurrency is too volatile to serve well as a means of exchange. I don't think Bitcoin is going to end up as the medium of exchange for the world, because it's too volatile, Munger said. He paraphrased the author Oscar Wilde's quotation about fox hunting to describe Bitcoin, calling it the pursuit of the uneatable by the unspeakable. When asked to choose which was more ridiculous, Bitcoin trading at $50,000 or Tesla's fully diluted enterprise value of $1 trillion, he quoted author Samuel Johnson, who said, "I can't decide the order of precedence between a flea and a louse." I feel the same way about those choices, Munger said. I don't know which is worse. Even if Bitcoin can overcome the hurdles necessary to be treated like a serious currency and store value in its own right, other problems remain. According to Munger, Bitcoin's success would facilitate a lot of illicit activity, due in part to the anonymity and the lack of regulation. There has been a frenzy of activity in the investment field. Nowadays, investors want to outsmart one another. I don't think we want the whole world trying to get rich by outsmarting the rest of the world, but that's what's happened. There have been frenzies of speculation and so on. It's been very interesting, but it's not been all good, Munger said. Over the next 10 years, market returns would probably be lower than in the previous decade. So many people are in it, the frenzy is so great, and the reward systems are so foolish. I think the returns will go down. Commenting on the surge in technology companies' valuations in recent years, Munger said he thought about Apple's worth compared with John D. Rockefeller's empire, and it's been one of the most dramatic things that's ever happened in the entire history of finance. If investors are worried about a market crash or that stocks are too expensive, a good way to protect themselves is to reevaluate their portfolios. Instead of buying Amazon at a PE of more than 70, they need to think about buying shares of a blue-chip healthcare stock such as Johnson & Johnson. This would be a much cheaper buy, and the business looks incredibly strong. It ticks all the principal checkmarks value-oriented investors should be looking for. It has consistently posted a profit, and only once during the past 5 years has its net margin fallen below 17%. Besides, Johnson & Johnson still has growth opportunities on the horizon, even though sales of $82.6 billion in 2020 were only nominally up from the 2019's total of $82.1 billion. Warren Buffett's longtime friend Charlie Munger considers the latest market rally to be one of the most surprising things that has ever happened in economics history. He does not expect investors to achieve the sort of returns they experienced in the last decade. He believes that we are all in unknown waters right now. No one has gone by with making so much money for so long without getting in trouble. Right now, there could be a considerably more devastating market crash brewing. If you fear that Charlie Munger's bearish viewpoints could come true, you should consider reprioritizing your capital. It would be best to invest in a defensive stock that can present you with growing dividends despite the economic conditions. Be sure to comment down below and let us know if we've missed something. Hit that subscribe button and turn on the bell to never miss an upload. Thank you very much for watching.